If you're needing us, would you please do us the honor of switching on your video, please? Thank you.
Okay, hold on. Let me make sure everything is open. All right. Let us pray. Heavenly Father, we thank you for this meeting. We thank you for the opportunity to come together and share and bless one another and learn from one another. As we go on today, Father, we ask that you be with us, that you guide us, give us wisdom, give us an understanding heart, a retentive heart, and a heart of discernment and learning. In Jesus' name we pray. Amen.
Amen. So if you're new to the community group, we welcome you. The Covenant Community Group is an initiative of the Covenant Nation under the shepherd, Pastor Koju and Pastor Toyin Mrs. Oyemade. Covenant Nation is based in Lagos, Nigeria, and the community group is also operational in Lagos. This is the diaspora arm of the Covenant Community Group, an initiative of the Covenant Christian Center. We're a Christ-based church. We follow the command and principles of the Bible. We're open to learning from even other faith, but we apply the wisdom and the understanding that we get, by the leading of the Holy Spirit. So we welcome everyone that has joined us this morning. So this is the month of finance. We welcome you to the finance up. We started last week. The finance team is led by myself and four the fantastic leaders. They're all here, with the exception of one. They're all here. Obina is here, Neka is here, Kingston is here, and Bolanle will be joining us before the end, and will be joining us as we continue the session. Last week, we began the finance month with the theme financial progression, and we started last week with Neka, Obina, and Kingston sharing wealth of knowledge, catering both to the North America, the Europe, and then the Oceania members. So for this week, to follow up on our conversation of last week, we have a member of the community group. I know she's been a member of the community group for over a year. I can say to that. So this morning, she will be sharing a wealth of knowledge and experience with us, understanding investment as a finance, as an investment tool, understanding insurance as an investment tool. So this morning, we have the honor of Yemisi Legushe. Yemisi lives in Ontario, Canada, with her husband and 3 children. She has a background in food science and a master's in storage technology. She's licensed to practice insurance in Canada with a diploma in financial strategies. So we welcome you, Yemisi, and then the floor goes to you. She will be making a presentation, but please remember that we learn by engagement. So please do ask questions, drop your comments in the chat, and make your own contribution also. So once again, welcome everyone.
Thank you for that wonderful introduction. Thank you very much. Please, can you hear me?
Yes, we can.
Oh, okay, thank you. And thank you also for the opportunity to share. It's a privilege and I don't take it for granted. We all can learn from each other. I'm open to learning too, please. And like she mentioned, yes, I'm licensed to practice in most provinces in Canada. If that is okay, please, can I share my screen so we can go pretty fast? 1 minute, right here. Okay. So I've been asked to talk about understanding insurance as an investment option. So why do we actually need to use insurance as an investment? I would answer that question by using this illustration. If you want to build a house, you actually need a foundation, right? So if you want to invest, you actually need a foundation, and the foundation is insurance. And I have another illustration to explain that fact. Let's say I have a friend or a client that tells me, oh, Yemisi, I want to invest 5,000. I have 5,000. I don't want it to just stay like that. I want to invest it. My first question is, are you insured? Is your family insured? Because if you say you have 10,000 or 50,000 to invest and you are not insured, if anything happens down the road, because yes, we are all Christians. We believe in God the Father, God the Son, God the Holy Spirit, and He has promised us long life. But we all know this fact. We don't know the time and the day that we are going to go home to rest. We don't know. So the foundation, actually, before you can invest, it's to build your financial foundation. Insure yourself, insure your family, because you don't know the time and date. So after you protect yourself, protect your family, then you can start to invest. In other words, if you go ahead and invest 5,000 or you go ahead and invest 10,000 and your family is not protected, if next week or next month something happens to you, technically all your family has is just the $10,000. How can 10,000 is not able to sustain your family? So why should we use insurance as an investment? Number one, insurance serves as the foundation of your financial house. Number two, you can actually invest under insurance. And it is through setting up a permanent life insurance. So in Canada, and I believe it applies to USA too, I don't know of UK, so I hope somebody will be able to educate me in that aspect too. So for US and Canada, I know permanent life insurance is two types. We have whole life insurance and then universal life. Those two options are the categories you have under permanent life insurance. So the next question that I would want to answer is, what is insurance? Insurance is a risk transfer strategy. We all are aware that, yes, you have car insurance, you have house insurance or mortgage insurance. You have heard that, right? Life insurance also is synonymous to those categories, but you are insuring your life. In case life is short, your family will get the death benefits. They are financially secured. So insurance, technically, or in a layman language, is just a risk transfer strategy. You are transferring the risk of you getting into an accident, and then you transfer the fees you're supposed to pay out of pocket. You're transferring it to the insurance company. That's why you get car insurance. So when you have dental insurance, you're transferring the risk of having dental issues and paying out of pocket. We all know is ridiculously expensive. So you get dental insurance to secure your payments when it is time to get a dental care. So for life insurance, it's synonymous to car insurance and all that. You are transferring the risk of dying to an insurance company. So if you die, the insurance company has the liability to pay your beneficiaries a lump sum based on the coverage you applied. I hope that is able to explain what is insurance. Then I already answered the last question right here. So I mentioned the types of permanent insurance, but we actually have two major categories of insurance. So we have temporary and permanent life insurance. So temporary means it is temporary. From the name, it means temporary. It means it is valid for some years. And I'll go ahead and share my next slide. That is okay. So I'll use this slide to explain the different types of life insurance. Term insurance is temporary. It means it is valid for a couple of years. While whole life and universal life is permanent coverage. So under permanent coverage, you have what is called insurance coverage, insurance component and investment components. So it is the investment component of your permanent life insurance that is going to grow cash value. You invest today, of course, you don't expect your cash value to grow the next day. It's just like when you sow a seed in the soil, you have to water it. It means when you have an insurance, you have to continuously pay your premiums, and then after some years, so insurance is for a long-term investment. After a couple of years, the investment component of your permanent life insurance is going to grow, and that is what offers you cash value. So at some point, based on the contribution you make, you can actually withdraw from your cash value tax-free. So growth potential is available under whole life and universal life. Why? It's because your money is invested for you. So your money can actually grow, but that is only available under permanent and universal life. So in terms of investment, universal life is the only permanent life insurance that offers you the option to determine where your investment should be. So for term insurance, you cannot even invest on that term insurance. Whole life, your money is invested in under whole life, but you don't know where your money is invested. That is the way it is set up. You don't know. You're only investing there, but you don't know what category, what industry your money is being invested in. So the fun part with all that are Christians, we actually want to know where our money is invested. So it's only universal life that offers you that option. For premiums, your term insurance and whole life is guaranteed. So if you say your contribution or your premium is X dollar, you pay X dollar, you cannot alter it. If you alter, it means you want to cancel the policy. But for universal life, your premiums or your contribution is very flexible. It means you can increase your contribution, you can decrease your contribution, you can even go on premium holiday. It means probably after contributing for 2-3 years, you are involved in a lot of projects. You can actually tell the insurance company or your financial advisor that, oh, for my universal life, I would like to put it on hold for 2-3 months. You can do that, but that is only available under universal life. So I'll stress the fact that you cannot open insurance today and then get the benefit tomorrow. The benefit you're going to get is going to be based on a lot of factors. The contribution you're making, and the duration of your contribution, and a lot of other factors. So in terms of cost, term insurance is very, very cheap. It is ridiculously cheap, but let us understand why term insurance is cheap. Number one, I think I have emphasized that you cannot even invest on that term insurance. So one, it is cheap because you cannot invest on that term insurance. The second reason why term insurance is very cheap is because if you cancel it, you have nothing. You don't have any cash value. Number three, it is only valid for a couple of years. It cannot serve you throughout your lifetime. Most term insurance you're going to see there is T10, T20, T30. Is always cheap. And is the attracting point, right? People want to take insurance that is cheap, but the annoying part with term insurance is, let me give you a scenario, like a 30-year-old lady, she takes up term 30. That means term 30 is that term 30 is only valid for 30 years. So 30 plus the 30 years coverage, by the time she's 60 years, she doesn't have any coverage. So if she decides, oh, I want to be covered, no, I want to continue, that term insurance is renewable. But it is going to be renewed, and then her premium will be based on her current age, 60. So the amount she will be paying at age 60 is going to be ridiculously expensive. So that is what term insurance offers. The good thing with term insurance also, I'll point this, is you can use it to set up mortgage insurance if you want to, but it's not compulsory. If you can use your permanent life insurance for your mortgage too. You can use it for several things. You can invest under your permanent life insurance. You can withdraw cash value from it. You can use it for policy loan. You can also use it for collateral loan. And I put this, I hope they're going to share this link. I mean the PowerPoint, right? I put that link in there for you guys to just check. The scenario I'm giving is related to Canada. And 90% of the time, this also works in the US. So right here from the website, Government of Canada, we are all, we Canadians are a little bit familiar with their website, right? It talks a little bit about life insurance. It says term insurance pays a death benefit if the person insured dies within a specific, you have to die within that period. As Christians, we cannot die young, so you don't even need a term insurance. So the length of the coverage is a fixed period, such as term 10, term 20, just like I mentioned. But let us go to the one that offers us the options to invest. Right here, permanent life insurance gives you coverage throughout your lifetime. Your survivors will get the payments if you die at any time while your insurance policy is in force. Permanent life insurance policy builds cash value. This means you can get cash value back, less the amount you paid in premiums for your insurance costs, even if you cancel the policy. So even if you cancel the policy, you most likely you are going to get a cash value back. But they say less the amount you paid in premium. So I will explain this phrase in the inside the parentheses. It means permanent life insurance has two components. Whatever you're contributing is going to two different categories, your insurance and your investment. It is your investment part that generates the cash value. So now you can see that even if you cancel your policy, probably after 10 years, you can still get money back. Then the third phrase, which is what I want us to learn something from today, it says you may be able to take out a policy loan or use your life insurance policy as a collateral for a loan. You guys will understand that it is something that is considered an asset that can be used for a collateral. We are all used to the fact that in Nigeria, you have a house, big house, you want to get a loan, you use your house as a collateral, right? So if on this page that belongs to the government of Canada is telling you that your life insurance is as valuable as an asset and you can use it as for a collateral, I think it's worth using it for investment option. It now says, it says, if you borrow using your cash value and don't repay the loan, you can borrow from your cash value, you don't need to repay the loan. It now says, because you did not repay the loan, it may reduce the amount of money your beneficiaries will receive. So let me first explain this part. Let's say you have a $1 million permanent life insurance on your life and you pass away by age 90. But during your lifetime, when you retired from probably age 65 to 90, you did collateral loan. And then you were able to enjoy like $650,000 during your lifetime. It means your beneficiaries are going to get 350, which is 1 million minus 650. That's what it means. That is the explanation for this phrase. So here it talks about the different types of permanent life insurance. We have whole life, universal life. So you have two options. Whole life insurance is a type of permanent life insurance that provides you coverage throughout your lifetime. Your premiums won't change as you get older, excuse me. Your policy will often have a guaranteed minimum cash value. So whole life offers you guaranteed minimum cash value. Yes, the cash value that you can withdraw is guaranteed. There's a minimum guarantee. But like I told you, for whole life, you have no idea where your money is invested. You can't make a choice. Oh, I want my money to be invested in Tesla. I want my money to be invested in a group of tech companies in USA. You have no choice. You actually don't know. So you actually need to ask questions. You need to know where your money is going to because we are Christians, right? So the second type of permanent life insurance that offers us the option to invest is universal life insurance. It says it's a type of permanent life insurance that combines life insurance with an investment account. This is what I mentioned earlier. The investment account has a cash value. Withdrawals and loans are permitted. So I've emphasized that part, and then I'll go back to the presentation. I'll go to the next slide. Okay, so life insurance can also be used for your retirement planning. Why do I say that? It's because, like I mentioned, you can use your permanent life insurance to get a collateral loan from the bank. So you get a collateral loan, you can get it during your retirement, especially for we immigrants that we came into Canada when we were a little bit advanced in age. We are 40, 41, 45. We have less than 20 years to plan for our retirement. And if you understand the system in Canada, you actually need to plan for your retirement. Why do we need to plan for our retirement? It is because the Canada pension plan is not enough. For CPP for this year, 2023, those that retired this year and they are age 65, CPP for retirement at 65 is ridiculously very low, $1,306.57. So based on the present economy, it's not enough. By the time you pay for your rent or your mortgage, you pay for car insurance, you pay for feeding, accommodation, Wi-Fi, phone bill, you have nothing left. So you actually need to plan for your retirement during your working years. So what is insured retirement plan? Insured retirement plan is, the meaning of that term is using your insurance as your retirement plan. How does it work? You set up a permanent life insurance with a licensed financial advisor. Feel free to ask the financial advisor you're working with, feel free to ask them that you want to see their license. It is your right. The next one is, after you set up your permanent life insurance, always review the performance of the investment components every year with your advisor. And then the third component is at retirement. Once the policy has accumulated significant cash value, apply for collateral loan. Always choose capitalized interest. So it says at debt, the loan is repaid from the tax-free debt benefits and the balance is paid to your beneficiaries. I explained this part from the link I selected. So what is insured retirement plan? This is a little bit illustration regarding that. But I want to share this page first. This is you can get this online when you just type in estate planning checklist, Financial Consumer Agency of Canada. If you put in those words, it is going to bring you, you're going to see a PDF, just click, it's going to bring you here. So right here, it says your estate planning checklist. Leave a will. Guys, leaving a will in Canada helps you to protect your family. If you don't have a will and you pass away by accident or by nature, your property or whatever belongs to you is going to be shared based on the provincial law. Wherever the province where you live, they are the ones that will determine how your estate, we call it estate, but it's not what we understand as estate in Nigeria. Estate here in Canada means what you have, your assets. So your asset is going to be distributed based on your provincial law. So it's just like, say you're working and then you want the government to share your property. So you don't want to do that. So getting or writing down a will is very, very important. And usually you have to update your will, probably every 2 years. Name beneficiaries in insurance and other policies. Plan for your funeral, prepare. Where am I going to? Here from Financial Consumer Agency, it says buy life insurance to cover expenses. Because the death benefit, according to the income tax law, is tax-free. So you're building generational wealth. Even whenever you pass away, you're building generational wealth to your survivors, to your children, to your family. And at the same time, as I have proved that you can also use your permanent life insurance while you are alive. It is called living benefits. So there are all other checklists for you to establish. But here it says buy permanent life insurance as an investment. So it is mentioned here twice. If it is not legal, if it is not valid, if it is not something that can help, we in Canada, they would not mention it here. So it is a valuable policy. It's a valuable asset. Buying a life insurance is a valuable asset, and you can use it for investment. Why would you even use life insurance for investment? It is because it is secured. The investment is always capitalized, number one. Number two, you can use it for your retirement. Your family gets the benefit tax-free. That is it. Most of the other investments you have, mutual funds, name it, is taxable. Go online and check whatever I'm saying. Mutual funds is taxable. RRSP, you are going to pay taxes in the future. So you have to consider your options and choose tax advantage investment. So now I go back to the slide and then I check this. Insured retirement strategy. What does Ivari has to say about it? Okay, for many people, an insured retirement strategy can be an effective way to plan for your retirement. This strategy provides two distinct benefits. It enables you to generate additional funds in retirement. Okay, and then I have another one from BMO. Let's learn from the banks because the banks have this to offer you. But the thing with the bank is, from experience, we all know that they have requirements. So at this point, I would like to explain that in Canada, and I believe in the USA too, there are 4 major financial institutions, but most immigrants do not know. There are 4 major financial institutions. You have the bank, you have insurance company, you have credit union, you have trust companies. 4 different financial institutions. So any financial product you see out there, you can actually get it from the bank or from insurance companies. You have options. So don't always think you are restricted to the bank. And when you're able to compare what A has to offer, what B has to offer, then you're going to be able to make an informed decision. So let's look at what BMO has to say. BMO says, generally speaking, you need about 70% of your pre-retirement income to retire comfortably. So next slide, how can you save more for retirement? BMO says, get insured retirement plan. Like I mentioned, insured retirement plan is simply using your insurance as your retirement plan. They talk about their own target market. They have yes, please. Should I go on?
Yes,
I
please
think
do.
so.
Thank you.
Okay. So for BMO, they have a target market. They say 35 to 55. For we in the insurance sector, we tell you, even if your child is 2 weeks old, get them insurance because it's pretty cheap. For a child that is 2 weeks old, you can get cheap permanent life insurance for them, like $20, $50 if you want to at least get something that is reasonable. So for them, they have a target market. The target those are in good condition. Yes, it's always very good to do that. So you get life insurance when you have good health, because the rate is going to be standard for anyone who has health challenges, that are diabetic, anything, they are rated, their premiums are rated. So it's very good to get your life insurance early while it is cheap, the premiums will be cheap. Number 2, your rating is going to be standard. So it really talks about the target market. But how does it work? It says, determine a permanent insurance need, determine a deposit stream, apply for BMO life insurance. Well, you don't need to use BMO. You can use insurance companies. Select an appropriate investment portfolio. You can only select when you set up universal life. It says, once the policy is enforced, check to see that the plan is on track. At retirement, and once the policy has accumulated significant cash value, apply for a loan, that is collateral loan, from a third-party lender. Depending on the agreement and the arrangement with the lender, interest may be capitalized. The same thing, at debt, it means the loan you borrowed during your lifetime, you did collateral loan, you don't need to pay it. At debt, the loan you were able to obtain during your lifetime is used to repay the loan, and then your beneficiaries get the difference. So right here, if anyone is using BMO right here, please check with BMO. I heard about insured retirement plan. For the requirements for BMO, you have to be someone that has made an annual deposit of 25,000 every year consistently for 15 years before they can offer you insured retirement plan. So you can actually get this option with insurance company, and they don't place this kind of requirement on them. So I would like to pause here and welcome questions, or probably the next speaker is going to talk. Thank you so much for allowing me to share.
Thank you, Yemisi. So I do believe that people do have questions, and we have some questions in the. If you have questions, please raise up your hand, but I'll first read out the questions we have in the chat box. So AJ is asking, is it advisable to take out the loan from your cash value or against your policy?
I want to read the question again, or if you can just repeat it. I'm sorry, I'm a slow listener.
Are you able
to
to
read
read
that?
the questions from the chat yourself?
Okay, yes, I'm scrolling up. I haven't got it. There are 2 types.
Yes, please. It's from AJ.
Okay. The premium paid under all life insurance. I don't see it. There are two types of what again? Universal life and whole life. Premium paid under. What happens if you?
Yes, this question starts from what
Okay.
happens.
What happens if you purchase term 80 as part of setting up your whole life insurance so as to convert it into permanent life insurance? Yes, that's a very good option. It's a very good option. If for now excuse me, if for now you are trapped, like you have little funds to pay for your premiums, you can actually set up term insurance, but you have to be able to transfer that. We call it convert. You must be able to convert the term insurance to whole life within a couple of years. It depends on the provider you're using. So the standard is at least within 5 years. Some providers might offer you more options, but I know that within 5 years, when you have a term insurance, you can actually convert it to permanent. But the premium is not the same. So since you want to convert temporary to permanent, you can do it. The premium is going to be calculated. The insurance company will calculate the premium you have to add to whatever you've contributed before. Is it advisable to take out the loan from your cash value or against your policy? Thank you for this question. So these are two questions. So when you do policy loan, you do your policy loan with the insurance company. So policy loan is actually taxable. Yes, policy loan is taxable. But if you want to do collateral loan from your cash value, it is tax-free. So you have to understand why you are using a particular strategy. You can have a 1 million permanent life insurance and you walk up to your insurance provider or you tell your financial advisor, oh, I want to take up policy loan. Of course, they have to tell you the consequences. You can do policy loan, but it is taxable. The only thing that is not taxable is the collateral loan. And I can share my screen if that is okay. I think I should be able to pull that out. This information is with, let me just go online. Sorry. Let me go to Google. If you type insured, can you see my screen, please? Please, can you see my screen?
Yes, we can.
Yes, we can.
If you just type, thank you. If you type insured retirement plan PDF, you are going to see everything I just shared. You're going to see it online. So scroll down. It is TD Bank that explains this. TD Bank says the first statement, you can leverage on your life insurance. It is another potential source of retirement income. Okay. It says life insurance is useful for more than just providing an estate to your family when you die. So I'm going to scroll down to save us time because it's a repetition of everything I mentioned. It now says there are 4 ways to use your cash value in your policy. You make a withdrawal, it is taxable. You get dividends paid out to you. When you have whole life, you can do this, whole life permanent, but it is taxable. If you secure or take out the policy loan, it is taxable. You use your policy as collateral with a bank, it is non-taxable. So if you are someone like me, I'm going to choose the 4th option because I don't pay taxes. I hope I was able to answer that question. Let me go ahead and check the next question. So the next question from Mr. Eddie Ajayi says, are there health conditions that will stop insurance companies from giving you a policy? Absolutely, yes. Most insurance companies will not insure you when you have health challenges. Cancer, you're diabetic, type 1, type 2, what they would not. So I'm already screaming already because when I tell people you have to get it as soon as possible. Get it now. 1 is good, cheaper for you. But based on the country now, based on the continent, there might be some exception. So in Canada, I know only 1 company that can offer someone with challenges, health challenges, that can still offer them insurance. But the maximum they can offer you is maybe like 100,000 or 150,000 coverage. They call it funeral expenses because funeral expense is expensive in Canada. On average, 20K is required to bury someone. So for now, based on what I know, there is only 1 company that does that in Canada. every other company is going to deny you. Okay, can you please take some questions? Okay, so AG, I like this question. It says most temporary insurance will not consider your health situation, but permanent life insurance will run a health check on you. Yes, we all want quality. You want a quality, you want quality protection, you want permanent. So the reason why they have to check your health situation is they want to know the person they want to insure. They want to know the risk that they are taking upon themselves. So when you want to get quality, of course, they should go ahead and check your medical history. So I'm not sure if this is a question or you are trying to say yes. For those with health challenges, you go ahead and apply for temporary. But it is temporary. It's just valid for some years. It does not even offer you the option of investing. Okay. Please, you can rephrase the question if I didn't answer it. Most likely, I didn't understand it. Okay. How is life insurance beneficial to newcomers, young adult families with children? Thank you for this brilliant question. Is beneficial to newcomers because yes, we came in as immigrants. Once you get your insurance early, it offers you the option of getting low premiums. Like what I mean is, assuming you come into Canada this year and you're 38, the premiums you would have to be, because it is a system, it is a software that generates how much premiums you are going to get based on the coverage you apply for. So this system is always going to determine your premium based on your gender, your age, and some other factors. So if you are a newcomer and once you get your permanent job, you have a stable income, get life insurance. Because if you don't get it now, you are still even going to get it in future. So getting it in the future is going to be a little bit pricey than getting it early. So it protects your family because life might be short. It protects your young children. It helps them to secure funds for their post-secondary education because you have to pay that from your pocket. Except you want your children to go and take student loan 100%. We as immigrants back home, we did not have the option of student loan. Our parents paid for our children's, they paid for our own education. So if you want to make sure that your children love you based on the fact that at least you assisted them with post-secondary education, you are building the love bond between you and your family. Because come to think of it, these children, they know that you as parents in Canada, you receive CCB. Trust me, they know. So by the time it's now for them to go to college and then you say, no, I didn't save money for your post-secondary education, that is not acceptable. What is acceptable to me, well, I speak for myself and I hope I'm speaking for most people here, is I'm sorry, this is what I can afford. I only saved 40K for you. Please use this. I know it's not enough. Go and get student loan. That is still acceptable because you tried. But for you not to just secure anything for your kids, that is a little bit not too good. So please, Mr. Samuel Martins, I would like to take your questions.
Okay, thank you. You've given us a lot of information today, and it will take a while to really sit back and digest that, hopefully through the recording. But my question is, as an expert, which one did you do?
Did you say which one do I use?
Yes, which one are you using? Because if I'm to decide based on all the information you have given today, it's leaving my hair in knots right now. So which one have you done? Which one did you do for yourself, for your spouse, for your children? Because while you were speaking, I had to go back to, just search through my emails, and I had to look at my the document that was sent to me when I did an insurance, and sadly, it's a term insurance. So for me, that's heartbreaking because I didn't know anything about insurance. So to me, then insurance was insurance. So no, back then, I'm talking about back then. That was because I did not have this section back then. So right now, all I'm interested in is this. As an expert, which one have you done? Let me learn from you. Just give me a brief overview of what you've done for yourself and your kids, and then I'll probably schedule a one-to-one session and then to get more insight. But for now, what have you done and what is actually working for you? Thank you.
I'm sorry, it's heartbreaking. I'm sorry that you had to experience that. So for me, I set up Universal Life. I, what is the past tense of what's the past tense of- Sorry about that. I just wanted to crack up. So I did Index Universal Life. I'm a risk taker, so I like to invest my money in. So the investment part of my own Universal Life is in high interest investment. So it's not for everyone. I'm talking about the investment company, but I did Index Universal Life. Why did I choose Index Universal Life? It is because my money is invested in a group of companies, not just one company. Whenever you see index funds, it means probably 500 companies, 60 companies. When it comes to Toronto Stock Exchange, it is 60 companies that form TSX. So when you're talking about S&P 500, for that, because of that 500, everybody knows that it's a group of 500 companies. So index funds gives you the ability to diversify your investment. You're investing this amount, but it is diversified. That is what index fund offers. So I hope I answered your question, sir.
Yes, you did. And do you also have coverage for your children?
Yes, I do. My
Is it also indexed or?
Yes, index.
Okay. All right, no problem. I'm pretty sure we're going to get your details to stay in touch with you. And I think I've already connected with you on LinkedIn. So I'll follow on that. Another question I have is I've seen and heard people talk about what the Rockefellers have done, that they put all their something in a trust, and then the trust is the beneficiary, and then from there, that's how they're able to have generational wealth and stuff like that. Is that something that also you also cover in your practice, or something that insurance can also take care of for me?
Thank you for that question. When it comes to trust, you have to deal with a trust company. The only thing I do in terms of trust is, if I am processing an application for a client, there's a point I have to ask them, do they have kids that are younger than 18? If they have kids younger than 18, when I name their kids, there has to be a trustee, because your benefits, in case you pass away and you have gone to rest, you are enjoying heaven, the death benefit cannot be given to your children that are younger than 18. They will not get it. So you have to name an adult. It could be your spouse. It could be an uncle you trust. It could be someone that is above 18. So I name a trustee for that beneficiary, because the beneficiaries on file are under 18. That is my job. So when you want to do anything trust, like I mentioned, in Canada and I think in US, you have 4 major financial institutions. We have things peculiar to each. We have banks, we have insurance companies, we have credit unions, and then we have trust companies. So I have a little bit knowledge about trust companies, but you will actually want to read up on trust companies. You can do, that's another topic. That's another topic. So there is a 21-year general rule regarding trust companies, and it's going to be a different topic entirely. So I can probably do something in the future regarding trust companies, if that is okay. But the first thing, the first foundation is get insurance, name beneficiaries on your life insurance. For trust, it is when you have kids that are under 18, then you have to consider trust, setting up a trust for them. Like your house, you and your spouse, you are the beneficiaries on your house. Sorry, you pay for the house, right? But there's a way you can set up a trust for your children so that they don't pay the tax bill liable upon the partner's death, upon you and your spouse's death, so that your child will not be paying taxes because you left them a property. So that is another discussion for another. I hope I was still able to explain a little bit.
Yes. In fact, you just hit the nail on the head right now, because that's transferring property so that they can evade, or well, not evade, but they can be exempt from that tax, that thing that the government will want to take you know, if anything happens when you're moving property over to your offspring. So that is the one, and I hope that that will still be addressed. And like you said, in future maybe you would have a session on that. It's quite what I'm looking for. Thank you.
Okay, sir. Okay. I think somebody raised hands before.
Yes, CMC, I raised my hand.
Yes.
Thank you for a great presentation. I have this question. Why are term insurance policies so well marketed? Because I find that a lot of people I've spoken to about insurance policies, they rave about term insurance policies. I mean, we could argue that the costs, right, is cheaper than the universal, but I've always gotten the impression there's some magic wand with term insurance policies as to why it's so well marketed. I seem to know more people with term insurance policies, and I don't have a term insurance policy, but I was going to get one just because. But what your presentation has changed my mind on that. But I'm just wondering, why are they so well marketed?
So thank you for that question. The reason why it's marketed is it is cheap. And it is we immigrants that are actually affected. Trust me, it is we immigrants, because when it is cheap, you want to go for at least you have something. Yes, it's good. You have something because that is what you can afford, but you have to know that term insurance cannot offer you anything. It's going to lapse. It means it's going to expire. So the reason why it is marketed, I would say, to immigrants is because it is cheap. And most of us, we might not be patient enough to actually ask questions. Like I remember before I went to financial college, I met a guy, and immediately he was talking to me about term insurance. I went online. What are the benefits of term? What are the benefits of permanent life insurance? And I asked him, does term insurance offer me cash value? He said no. I said no, I want permanent. On the spot. So it's just like we have to be curious. Don't be afraid to ask questions. When somebody offers you something, please ask questions. What is the disadvantage of this? What is the advantage of this? Like, I will use this as an example. Like someone, you walk into a bank, they offer you RRSP. They say it's tax deductible. My friend, it's tax deductible. But do you know that tax deductible, you are going to enjoy it when you are young. You file taxes next year, you're going to get money back. But that money that you're collecting from the government, you are going to pay it back when you retire. So which one do you want? You want to enjoy now and pay later when you retire. Whatever you're planning now should be for your enjoyment when you retire. So I'm just using that as an example because, yes, they offer you RRSP. They say it's tax deductible when you offer it. Yes, but you have to ask questions. Ask questions. Oh, you told me it is tax deductible. After that, what happens? At retirement, how am I affected? What are the pros and cons? For me, I'll tell anyone that wants to listen, you don't need RSP if you earn lesser than $80,000. You don't need it because you are enjoying now. The tax rebate you're enjoying now. The government are wise. You're going to pay it back. Just Google it. Will I pay taxes when I withdraw from my RRSP at retirement? You are going to pay that taxes. All the tax reform you are enjoying during your young years, your working years, you're going to pay it later. So I know term insurance is marketed, but let's ask for options. What are the disadvantages of term insurance? Like there was a point I said, why is even term insurance so cheap? Why is it? It is cheap because it's going to expire. It's going to lapse. It doesn't offer you cash value. You can't use it for policy loan. Yes, you can use it for your mortgage loan, but it's just for 20 years. Like if your amortization period is 20 or 25 years. But we want something that is quality and then offers you a lot of benefits. I hope I answered the question.
Thank you so much, MC.
Thank you too.
Okay, I have a question. During your presentation, you showed us the life insurance products from the bank, but then you also showed a bit one that was from an insurance company. Can you show the one from the insurance company and then explain why is it better to purchase permanent life, whole life insurance with an insurance company as to the bank? I know you mentioned the requirement for BMO, but can you please just present the one for the insurance company again?
So, Let me look for that. Insurance company. Is it this one? Or let me just go here. Okay, I'll just type it in. Let me go here. Okay. So if I understand your question, you said, why is it good that you purchase it from an insurance company, right? Is that your question?
As to a bank.
Thank you. So from the word insurance, that product belongs to insurance companies. So if you go get it from the bank is just like a third party. That is how I can explain it in that simple perspective. The bank, yes, like I mentioned, we have 4 financial institutions, and all these 4 financial, they have something peculiar to them. If you are patient enough, just go on Google and type bank-owned life insurance. The bank themselves, they own life insurance, especially on those that are, let's say, CEOs and stuff like that. We call it key person life insurance. Like they take life insurance on people that they know if anything happens to their life, the company is going to be affected. So it's a way of shielding the company. So if the bank can own life insurance, well, we all need to do that. I hope I answered your question now.
Someone else has a question.
Yes, ma'am. Please go ahead, Madam Anu.
No, my name is Anu. There's no
Our
madam.
governor.
Relax. Please, I have questions.
She's not governor, please. She's board member.
No,
Board member, I'm sorry.
How can you say governor?
Please,
Can be
no,
penalized.
no,
Able board member. How can you make such statements?
that's an unpardonable
That's
sin.
excellency. That's our board member.
Yeah, money
Excellent. I'm sorry.
matters. Money matters. Please, let's focus. Do I still need life insurance, even though, so as part of my benefit, I have life insurance with my employers. So do you still recommend that I take another one out personally?
That's a brilliant question. Thank you, ma'am. The reason you actually need to take an individual, we call it personal life insurance, is if you change jobs, like you're working with a good company, they offer you group coverage. If you leave that job, the insurance coverage is gone. So you start from square one when you go to another company. That is what it means. You can't take that life insurance with you. It's offered by that company. You leave the company, you lose your coverage.
Yeah, but then, so while I'm in that company, I can, so this is what I'm thinking. Please, I'm very open to being educated. I'm thinking, okay, I mean, with these employers now, even though I'm thinking strategically about my career, I don't have immediate plans to leave. But once I know that I'm going to leave, then I go and buy my own personal one. Is that a good move? Or you are recommending, while we are there or you're not there, go and buy your own?
Thank you for that question. The earlier the better. I'll use this as an example so that you understand.
Okay.
Let's say, I assume, it's just an assumption. I'm sorry, please don't take it personal. I just want to use a number.
Yeah,
let's say you are 40 this year, and this is the year you started to work with a company.
Okay.
You like the company, it works well. You have spent 7 years in that company. That means 47. So the premium you are able to get for a permanent life insurance when you were 40 years old, honestly, there's going to be a huge gap with what you are going to get when you decide to now apply it when you are 47 years old. So to answer your question, you get it when you can afford it. You get it at a younger age. You don't have to push it forward. You push it forward, it is called procrastinating. When you procrastinate, you are going to still pay an expensive premium.
Okay. Thank you very much. Thank you.
Did I answer your question, ma'am?
Yes, no, yes, you did. Let me say thank you so much. Thank you.
Yes, ma'am.
I'm sorry, let me just quickly add, I was with a previous employer at the time, and I looked at the terms of the insurance coverage that I had, and all they were covering me for was just for $100,000.
Wow.
Just for $100,000. When I looked at it, I mean, it was sad. And then when I left that employer, the insurance company reached out and they were like, "Oh, okay, so you're going to lose the coverage that you had, but if you want, you can start paying like so and so amount so that you can continue where they left off. And I'm like, no, I'm not doing that. It's just for 100K. So why will I do that?
Thank you for bringing that to mind. I really appreciate that. Thank you, sir. So another point regarding group insurance is you cannot be given a good coverage. That is just the simple truth. You cannot be given the coverage that you actually need, because they always believe this person, yes, we need you to work with us. They don't expect you to work permanently with them. So they are not insuring you. Whatever they are insuring you is just for your funeral cost. Like you said, 100K. Is 100K enough for your family? It is not enough. After that 100K cannot even pay for mortgage. If anything happens to you today and you still have mortgage on, 100K is not enough to pay all those bills. After funeral, maybe like 30,000 for funeral, remaining 70K. Maybe you have car loan, stuff like that. Before they start paying, there's nothing again for your family. So thank you so much for using that as an example. Please go ahead.
Okay, just to go back to my question, if you please go back, if you roll back your slide a bit.
Okay.
Yes. If you just
okay, this one.
Yes, this one. If you please just take it back a bit, because I know you said that this one. So for if I go to BMO, you showed the requirement that BMO will demand. I must have $25,000 contribution wise. But if I go to Ivari, do I have such requirement or demands to make before I can purchase? Because I'm looking at purchasing whole life, and then if I have to purchase for my children below 10, what will be the requirement in Ivari as compared to, will BMO also demand that children have that high contribution of $25,000 worth before they can have life insurance?
So I'm sorry, if I understand your question, you mean advantage of getting it with insurance company than getting it with the bank?
Yes, please.
Thank you for that question. You see, whatever you get in the bank, you can get much, much more with an insurance company. That is just the bottom line. For you to now verify, do your due diligence. Do your due diligence, yes. So when I say BMO, not even only BMO, National Bank, all these banks, they can offer you universal life. But see, for the mere fact that you are using BMO and they have not offered it to you, it means you are not in the category of people they can offer it to. That is the simple explanation. If you are in the category of people they can offer it to, you would have gotten a mail. Mrs. Yemisi, we are glad you are our customer for 5 years. Please, we want to offer you insured retirement. They will be the one to approach you. So for the mere fact that you have not been approached, it means you don't qualify. So for insurance companies, usually insurance companies they work with independent advisors. Independent advisors run their business based on the fact that they are licensed by the province. So they are able to offer it to any Canadian. In fact, I have clients that they just started their first job and they are able to get it. They don't have savings. They only have started a permanent job. And they know that the earlier they start, the less premium, the more benefit, the more time, the cash value in their investment is going to mature, is going to grow. So they get it. But they cannot get insured retirement plan. You get your first job and you say you want to apply for insured retirement plan with the bank. They will not offer you. I hope I answered that question.
Yes, you did very well. So we have a question from Olanike Adimakinwa in the chat box.
Okay.
Nike's question before then Gabriel's comment.
How about banks that have insurance subsidiary? BMO2 has insurance subsidiary. Most banks have insurance subsidiaries. So yes, they have subsidiaries. You can, like I said, do your due diligence, and then they will tell you the requirements for them to set it up for you.
Okay, so we have Adibowale Bakari's hands raised. Adibowale, can you please speak?
Thank you very much. I just wanted to chime in on the BMO insurance company dichotomy, I don't know what appropriate adjective to use to describe that, but I'll be asking if this analogy works for it, and I'll just be very fast about it. If there's someone that is into plumbing materials, sale of plumbing materials, like we have them in Nigeria. If you go there and you could find a few pieces of building materials there. I mean, just the person specializes in selling of plumbing materials, but they also do building, or they do building consulting. Rather than going to an architectural company, the reason for this analogy is that I used to work with a bank in Nigeria that had subsidiaries, wealth management, insurance, and all that. But when they looked at the fact that divesting from those subsidiaries would help the businesses grow, they divested from them, and those other businesses, like 6 or 7 of them, took off. So I just wanted to find out, or ask, or maybe add to what the guest is saying, that could it be that because the core business of the insurance companies is insurance, you probably would get the best offer possible from them than it is with banks that are only, in quote and unquote, dabbling into insurance? And then maybe there could be a few things that are hidden that you might eventually get to know down the road, because maybe it's just a business that they are into by the side, as against, you know, dealing with an insurance company whose basic and core business is insurance.
Okay. I think you buttress the fact. I don't think you asked the question. Am I correct?
Yeah, you're right.
Thank you so much for adding that. You helped me. Thank you so much. I appreciate that. Thank you, sir. So I would read the chat. Is there anyone that you can recommend that we speak to? Is this for me? Is the question for me? So
okay, so is there anyone that you can recommend that we speak to for the indexed universal life insurance? So are you to Oluwatosin Ajanoku, are you in Canada or are you in America?
US, okay.
Okay, so Tosin is in US. We had an American also. We had a person to speak also to the American market, but at last minute she was unable to make the call today. So hopefully, before the end of we are. If you look at the flyer, we had 2 personnel speaking, one to Canada market and then to the American audience also. For the Europeans, we didn't leave you out. Next week we have a speaker speaking on multiple streams of income, which also encompasses, investment tools. So we have you all covered. So we would attend to that. So for Tosin, the speaker we had for the American audience couldn't make it at the last minute today. But hopefully before we finish the session, we would have met this need also. If you do have any questions, please ask KMSC as she rounds up. AJ has his hands up. AJ and Victor.
Yeah, thank you very much for the presentation. I actually just want to make a contribution. So with the insurance policy, the setting up is very, very important. So when you're dealing with your policy advisor, you have to be careful what they put in it when they're setting it up, because there are insurance that when they set up, when something happened to you the next day, the insurance company can take over the premium where you don't have to continue paying the premium. But if that is taken out of it, then that will be a problem for you. And also, it's also embedded in blending of some of the insurance policies whereby it includes your health. So when you're sick or those, some of the insurance policies also involve that. So in a whole, the setting up of the policy has to be well detailed and well understood by you who is going to go in for it. So that is just the contribution. Thank you.
Thank you, sir. I like that. Yes, you have to be able to get a lot of information from the advisor you're working with. Usually, a professional advisor will explain your policy to you. You have term insurance, it's valid for 20 years. After 20 years, you have to renew it. They have to explain. If they don't explain it, they are not being fair. It's called fair treatment of customers. So they have to explain it to you. And you yourself, you have to also be curious please ask questions, like he rightly said. Thank you, Karen. So I think somebody else is raised this hand. But I'll take the question in the chat. Would it be better to do universal life versus doing your own investment? Given the investment option in the universal life may be limited and probably not beat the market in the long run. Okay, so doing universal life versus doing your own investment. I think I explained that in my presentation. See, I would only advise. The advice is, if you want to lay a foundation, everybody needs insurance. The earlier you get it, the cheaper it is for you. So actually using universal life and also investing on with universal life could be an option if you want to. So let me now say, okay, you don't want to do universal life. You want to do investment, just strictly investment. So we are immigrants. Most of us probably we might be able to invest maybe like 20K, $50,000. But for most of us, we are starting all over again because even to so let me even now say, okay, let me assume you want to invest 20K or you want to invest $50,000. If the market is doing well, that 50 could grow and become $65,000. If anything happens to you, that is $65, your $65,000 death benefit to your beneficiaries. It depends on the investment. If it is a taxable investment, you pay taxes. The only investment for Canada that is tax-free, apart from using your universal life as well, is TFSA. And TFSA, the maximum is 6,500 for this year. So for you to be able to save 50,000 inside your TFSA, please calculate how many years you have lived in Canada. Just 50,000 divided by 6,500. You must have lived in Canada for at least almost 9 years before you can accumulate that amount of money in your TFSA. So even at that, you now have 50,000 in your TFSA. It's tax-free. Your family will get 50K. What can they do with 50K? After burial, feeding, maybe 1 month. After 1 month, they are back to square one.
Sorry, can I add something to what you just said, Ian?
Yes, please.
Thank you for the presentation. I think that for the person who asked this question, there are two different things here, right? So what we're looking at here is financial progression, and we're looking at insurance as a tool to invest in to make an investment. So that is the focus of this. So there are two separate things here, but the thing I'm getting with taking out of what EMC is saying is, whilst you are covering yourself for your life, you may as well also do investment. It's like you're using one stone to kill two birds. So if you want to do investment, that's fine, do investment. But what she's saying here is, with a life insurance, you have a cover for your life, but you can then leverage on that to also invest. So those are, for me, an added benefit. So you're covering your life, and as well you are utilizing that avenue to do an investment. If you're doing an investment, that's just an investment. It doesn't have a life cover inside of it. Of course, that's a tool as well. So you have to think about it, what you want to achieve. If you want to stick with your investment, go ahead. Probably you have certain investment you can put your money into, and then it can yield you so much money. But again, remember, there are multiple streams of income. There are different ways of doing the same thing, and the more streams you have, the better for yourself. But I think that if I get a life cover in an insurance company covering eventualities, and I can turn that into investments, so my money is working for me silently while I'm doing so many other things, that's an added benefit.
Thank you. Thank you. I appreciate that. Thank you very much. I appreciate that. I appreciate that.
Thank you. So we have a question from Gabriel, and I do hope if you have any other questions as we begin to round up. Thank you, Mrs. so much. So can you please, Gabriel, are you asking the question? Okay, maybe it's not. Maybe we had this answer before. Victor, are you asking a question, please?
Yes. Okay, so I just relocated to Germany, and I have a permanent contract, but I still have some months as the probation period. So I just want to ask, when is the best time to start planning for the life insurance and yeah, and things around that? I just wanted to know.
Yeah, thank you for that question. The simple and short answer is as soon as you get a permanent job, you should go ahead and get a permanent life insurance. So the thing with insurance is it is based on your age. If you don't get it this year, by next year, the premium that is going to be generated based on your 2024 age is going to be higher than you purchasing it when you were your age at 2023. So once you can afford it and you are working full-time, go grab it. Every other investment, you can do lump sum investment. Every other investment, you can do it in the future when you are comfortable, because it is not based on your age. You invest, it has nothing to do with your age. It has nothing to do with your age. But insurance is based on your age. It is based on your health. What if you procrastinate it and 2 years time, you have something going on medically, you are affected by premium charges because you are going to be rated. You're going to be rated because you already have medical history. You already have medical challenges. I hope I was able to answer that question.
Yes, thank you.
Okay, thank you, sir. Mr. Gabriel, please, are you there?
Yeah, apologies. I was looking for my unmute button. I think I scrolled too far. Okay. Yeah, Missy, thanks for the presentation. I mean, that was really great. Actually, I don't live in Canada. I live in Hong Kong, so I mean, probably cannot use your services in that regard. But I mean, it's good to know about the universal life. I think it's probably my first time of hearing of universal life. I've heard of whole life and I've heard of the term insurance. Um, it's probably it's more of a comment as opposed to a question, but maybe there'll be a question in there as well. It's just a comment on what I'd posted regarding doing investment versus doing the universal life. I do agree with your view that it's better to do universal than to do term, but I do understand why term is pushed ahead of universal, especially, I mean, someone like Dave Ramsey. I don't know if you've heard of him. He's a financial expert that I listen to. He will call people that do universal or whole life insurance as being dumb and stupid, because for him, he says rather do term that is a lot cheaper. So you could just have a cover for your next 25 years while you invest your money yourself, and you basically be able to beat the market, or basically you'll be able to make more from that investment than what your investment or the insurance company may give you. So he thinks it's a dumb idea to do whole life. I mean, I do have whole life myself, so every time I listen to me, I'm like, oh, so I'm that dumb. But hearing your view, I'm like, yeah, same mentality I have. Why would I do term when there's no benefits? I mean, as in, if I don't expect to die in the next 25 years, so why should I do term? So, but I think the point I want to highlight here is I think there is a benefit of term for those who, like myself, probably, I mean, initially can't afford the whole life or the universal, and you want a bit of cover, peace of mind for 25 years. I think that maybe advisable to just do the term. And what do you think?
I know them very well. We don't have the same ideology. So we all have our personalities. I don't like his ideology, and I have my reasons. So when you say someone should do term and invest the difference, see, it depends on how much. If you have $1 million to invest, go ahead and invest. That 1 million can even generate passive income. But if you don't have money, even if it's just like 5,000, 10,000, 50,000 to invest, if the investment does well, sure it will grow to 100%. Even if it now grows by 100%, you have 100,000. Please, if you die, is $100,000 enough for your family? So you have to ask your question. You have to ask yourself that question. So the reason I don't have that I like term insurances. See, it is renewable. but it is expensive. I don't know if we'll be able to, if you guys can give me the privilege to share you a software we use to generate term insurance. In fact, when you see the software, you'll be angry because they don't show you the end part of term insurance. That is it. It is cheap. You buy it today. For a 32-year-old, 35, you might be paying ridiculously $14.50, $20. You think it's cheap. It's cheap. But when you get term 30, for example, is valid for 30 years. You are 32, you got term 30. By the time you are 62, you are still alive, to the glory, to God be the glory, you are still alive. If you want to renew that term insurance and you're already 62, the premiums that you will pay because you are 62, I'm not joking, it can be as high as $1,000+ per month. If I'm allowed, I can share the software, show it to you guys so that you actually need to understand term insurance for you to know that, well, if you want to do it, you at least you have the right information to make your decisions.
Understood. One more point or question. One thing I've found out with the whole life insurance, because I've done, a couple before, the projection you're given at the point of signing up varies so widely from what you end up getting by year 10 or year. So, yes, there's a death benefit which is consistent or constant. It's not going to change. But if one is depending on the investment part, that may go up or down, and in my case, I've seen it always never beat what they had projected or claimed that it will be. Is that something people should be aware of and be mindful of with respect to whole life?
Okay, with respect to whole life. So there are so many uses for your permanent life insurance. The one that comes to mind that will always make me happy is the collateral loan. See, investment is always like this. It always fluctuates. It always goes up, down, up, down, up, down. It is never stable. If anybody tells you it is stable, they are just deceiving you. So when you say for some time you've been experiencing negative, it's fine. At some point you are going to be able to get positive high values. So it's going to offset the negatives. So the good thing is you can use that. You already have whole life. You can still use your whole life as collateral when you retire. You can use that. So I hope I answered your question. And guys, please.
No, I think that's a very good point. The collateral, I keep forgetting that bit. All right, thanks.
Yeah, thank you. So guys, if you have kids, it's always very good to buy permanent life insurance for them when they are young. It is very cheap and affordable. Trust me, in the future, they are going to love you for doing that because you saved them a lot of money by getting it young for them. You have options when it comes to your permanent life insurance. You have whole life, you have universal life. So you have two options, but get it when they are young. It is cheap. Mrs. Eniola, go ahead.
Hello, I wanted to ask. Hello, I wanted
Yes.
to ask.
Okay,
how much do you pay in premium for your index universal life insurance?
My own.
Or maybe spec, or give me a range if you don't want it to be personal. Yeah. How much do you pay in premium? Monthly premium.
Okay.
For
What I pay is based on my age.
Yeah.
So currently I have two.
Okay.
I think 200. And then I have another one, 500. So
Okay.
it depends on what you can afford. You start small. Then the funny thing about insurance is you can have 2, 3. And then you have two different reasons for having it. Like you read your permanent life insurance at some point, yes, it depends on the amount you're contributing. You can actually withdraw from your cash value, but it has to be after some time. It's not you invest today, you get your money tomorrow. It is based on a calculation. So to answer your question, that is just an example. So
you pay 200
on one, you pay 500, or is it
Yes.
200K value you've got or 500K value?
I didn't get that. I didn't get your last statement.
I said, you said you pay $200 on one particular, that you have two, and you have one that you pay $200 on, and
Yes.
the other one $500 on.
Correct.
Okay, thank you very much. And can you speculate what the worth of the 200 is, or what the 500 is?
So all these questions you're asking me, I would like to understand where the questions are coming from, because my coverage is based on my age, and it's based on my gender. It's based on my age, it's based on my gender. So I have been told to show the software.
Okay.
So Mr. AJ, you said how much life insurance can you get as an individual? So we do financial needs analysis before we can tell you this is what you need based on your financial situation. So we cannot give you an insurance coverage that is higher than your FNA. We call it FNA, but financial needs analysis. If it is higher, the insurance company is going to scrutinize the advice or the broker that did the application. So it is based on your personality, the income you earn, how many kids you have, do you have a mortgage, are you with car loan, what debts do you have? It's a lot of questions. You have to answer those questions. There we are going to generate the insurance coverage that you need, and it is a personal value. No, you can't have the same value as your twin brother, especially if you are different genders. You cannot have the same FNA.
Thank you so much, Yemisi. We've had a very informative session with you this afternoon. So I do believe that we've learned much more than we knew before, and we're able to apply what we've learned and all that has been shared. So we have come to the end of today's session. Next week, we will be having a speaker from the Europe. We will be speaking to multiple streams of income and then investment opportunities in the European market. And hopefully before we also finish this month, we would have our speaker speak to us, the American audience, also insurance as investment tool and other vehicles of investment opportunities. So we'd like to say thank you on behalf of the leadership of the Finance Hub. Obina is here, Nneka is here, Kingston is here, and Holland is here. We say thank you. Thank you everyone for joining us this afternoon. Do enjoy the rest of your weekend, and then we'll see you next week again. Thank you, Yemisi. Thank you so much for today.
Thank you, Yemisi.
Thank you, everyone. Thank you for
Thank you.
Thank you, Yemisi.
Thank you.
Thank you.
Thank you.
Thank you, Yemisi.
Sorry, if the leaders will please
Thank
just
you,
wait
Yemisi.
behind, and Anu, if you please just wait with us. Thank you.
Thank you.
Bye.
Thank you.
Are you still recording?